Section 5 deals with real estate investing. The major reasons or the key reasons for investing in real estate are given right here. The big one is the potential for competitive long-term returns, and here we are talking about both income and capital appreciation. To understand this, think about an investment in an apartment building. When you make an investment in an apartment building, you will get income because all the tenants will pay rent. So that serves as income. And then the value of this building, or more specifically the land on which this building is constructed, will probably go up. That is capital appreciation. The second reason is that rent from long-term leases will lessen impact from economic shocks. If you think about a retail plaza or a shopping mall, let's say you have invested in a particular shopping mall and you lease out the shops or the facilities to tenants. Those leases might be 3-year leases on average. What that means is that over a 3-year period, you are likely to get your income regardless of how the economy performs. So this is less risky than many other investments. Real estate is generally considered a good diversification vehicle because there are some claims that returns on real estate have a relatively low correlation with other traditional investments, so there is a diversification benefit, and the value of real estate goes up with inflation, so real estate is also a good inflation hedge. These are the high-level reasons cited for investing in real estate. On the right side, we look at some basic investment characteristics associated with real estate investments. They tend to be indivisible, so if you invest in a given property, you cannot simply cut up this property very easily. Every property will have unique characteristics. The location is fixed. For commercial real estate, there's a fair amount of operational management involved. And you need to recognize that local markets can be very different from national or global markets. So if you look at a national index, it is possible that real estate values are coming down, but in a particular suburb in Chicago, for various reasons, you might have prices either flat or trending upwards. So you need to be on top of the dynamics in each local market. Here we talk about the different forms of real estate investment. At a high level, we can think of two dimensions: debt versus equity and private versus public. What most people first think of, and what most of this reading is about, is equity-oriented private investments. If you purchase a house or if you purchase an apartment building, there you have direct equity ownership in a particular property. You might be the sole owner, this might be a joint venture, or the ownership might be through a real estate limited partnership. But in any case, you have an equity stake in a particular property. As long as your share is not publicly traded, this would classify as a private investment. You can also have something called leveraged ownership. The idea here is that to buy a particular building, let's say the building costs 10 million, you might put 3 million of your own and you might borrow 7 million. This would be called a leveraged purchase or leveraged ownership. This bottom right box covers equity ownership in instruments which are publicly traded. The classic example is REITs. Most REITs are publicly traded, and the idea is this: a given REIT takes ownership in several real estate properties, and the REIT issues shares or units. Each share represents a percentage ownership in the underlying properties, and the income that is generated is paid as dividend to the shareholders. So the value of these shares obviously is based on the dividends, and if the value of the underlying property increases, that is beneficial. The key point here is that these shares are often traded on an exchange, and since they are traded, we refer to this as public instruments or publicly traded instruments. If we have shares in real estate investment trusts which are publicly traded, then that also would fall in this bottom right category. Coming to the left now, which is the debt side. If a bank issues a mortgage loan, that mortgage in of itself is not equity. However, it falls under the equity investment category because underneath that mortgage, the house is held as collateral, and the value of this mortgage does depend on the underlying property. So mortgages do fall under real estate investment category. Similarly, construction lending is also a debt-based instrument. These two items are not publicly traded. They are private investments. That's why they are in the private category. If you have publicly traded mortgage-backed securities or collateralized mortgage obligations, then these are traded on an exchange and are therefore referred to as publicly traded instruments. This slide deals with various investment categories. Residential property, this refers to investments in a residence where one intends to live. Generally, this would be leveraged equity, where if you are paying 100,000 for a particular house, you might initially put 25,000 of your own and borrow 75,000 from the bank. This would be a mortgage loan, and the equity could be referred to as leveraged equity. If the value of the equity goes up, then the benefit is to the homeowner or the investor in this case. The second category is commercial property. This refers to investments in a commercial property such as an apartment building or an office complex and so on. Generally, high net worth individuals and institutional investors invest in commercial property. Looking after a commercial property requires active management as well as a substantial amount of experience. These investments tend to be illiquid because if you buy a particular apartment building, it might not be so easy to quickly sell that building at market price in a short period of time. Number 3 is REIT investing, and I've already spoken about this. REITs can be further categorized into mortgage REITs and equity REITs. What I talked about earlier was an equity REIT because underneath that share, so as I mentioned before, they are the REIT shares. You have the REIT entity which issues the share, and underneath it actually owns real estate properties. So if what is owned underneath is real estate properties and this is equity ownership, then we call the REITs which are issued equity REITs. On the other hand, if the REIT actually owns mortgages or mortgage-backed securities and issues REITs where mortgages or mortgage-backed securities are held at this level, then the REITs that are issued are called mortgage REITs. Number 4 is mortgage-backed securities. These are debt-based instruments. They are covered in Exhibit 14 in the curriculum. I don't think you need to worry too much about the details, but at a high level, the idea is this. A given entity might own a number of real estate assets. The funding for these assets comes through some equity and debt. These would be mortgage loans. Against these mortgage loans, several securities could be issued. You might have high-grade securities with low risk of default, and then you might have other securities which have a lower grade, so the risk of default is higher, and at the bottom we have equity. So if there is loss in value, the first hit would be over here, then at this level, and then at this level. So these securities actually which are issued against the debt would be referred to as mortgage-backed securities. This material will be covered in a lot of detail at level 2 in fixed income securities. Then you can also have investments in timberland or farmland. When you talk about timberland, this is basically forests. Product is trees. The product produced is trees. The trees in the timberland keep growing, and it is a store because the trees can be kept in the farmland. They do not have to be harvested at any particular point in time. When it is appropriate, the trees can be harvested. The return drivers for timberland, one is organic growth. As the trees become larger, they become more valuable. Commodity prices, specifically timber prices, as these prices go up, that's another source of return. And finally, land prices. So the forest or the land where these trees are growing obviously contributes to return. When that land price goes up, that is a return. Farmland is perceived to provide a hedge against inflation. The output of farmland is obviously crops, agricultural commodities. As the value of those commodities goes up, the value of the crops obviously is closely related to the inflation indices such as the CPI index. CPI index partly is influenced by the value of these commodities. Return drivers, harvest quantities, commodity prices, and land appreciation. Real estate performance and diversification benefits. There are a variety of indices to measure real estate returns, and the three broad categories are appraisal indices, repeat sales, and REIT indices. Appraisal indices are indices where the properties that are being used to come up with the index value, and these properties are valued based on appraisals. So an expert appraiser will appraise the value of these properties, come up with a value, and the overall value of the index is based on the appraisals. So that index would be called an appraisal index. Another category is repeat sales or transaction based. Here the values are based on the actual sales price of particular properties, and then we look at the sales price of that same property the next time it is sold, and so on. And then REIT indices are based on the prices of REITs. If you have publicly traded REITs, then it is relatively easy to come up with the value of the REIT index. Exhibit 13 shows the returns of different US real estate indices. Exhibit 14 shows the return of global REITs. But the key point is the correlation between global REITs and stocks, and then the correlation between global REITs and bonds. The correlation between global REITs and stocks in this time period was 0.6, which is relatively high, whereas the correlation between global REITs and bonds was 0.3, which is relatively low. So the major takeaway here is that the correlation between REITs and bonds is much lower than the correlation between REITs and stocks. Real estate valuation. There are three broad techniques for appraising real estate property. The first one is comparable sales approach, and this is perhaps the most commonly used. Here, to value a given property, we look at the transaction values of other comparable properties in the region. The second is an income approach. Under income approach, we are considering two subcategories: direct capitalization and discounted cash flow. Direct capitalization is an application of the Gordon growth model. What we say here is that for a given property, let's say an apartment building, we estimate the net operating income. So let's say the net operating income for the first year is estimated, and say that is NOI. And then we assume that this net operating income grows constantly and perpetually at a rate G. And we also make an assumption that the appropriate discount rate for this cash flow is R. Then the value of the property at time 0 is given by the net operating income at the end of the period divided by R minus G. So as I mentioned before, this is your Gordon growth model. And the reason this is called direct capitalization is that we are taking the net operating income, which is income figure, and we are dividing by this number R minus G, which is called a capitalization rate, and we are coming up with the value, which would be the value that you pay or the value that ultimately will go on your balance sheet. So simplistically, we are calling this a capitalization. The other is a more typical discounted cash flow, where we might consider taxes and other factors to come up with a projection of cash flows, and then we discount those cash flows to come up with a value. And finally, cost approach. This involves figuring out the cost of reproducing the same property. If you are coming up with the cost of an apartment building, one way of doing it would be to estimate the value of the land and then estimate how much it will take to rebuild something similar. That would be a cost approach. And all this material is covered in a lot of detail at level 2. So I do not expect any quantitative questions at level 1. With REIT valuation, we can either have an income-based approach or an asset-based approach. The income-based approach is similar to direct capitalization, but we need a measure for income. So here we had net operating income. With REITs, we use a measure called FFO, or funds from operations. At times we use a measure called adjusted FFO, which is FFO with some adjustments. And here is the formula for FFO. This should look a lot like a cash flow measure, because you are taking your income, adding back depreciation, which is a non-cash charge, and then you are subtracting gains from sale, and so subtracting the gains from sales, adding loss on sales. I don't think there is a high probability of being tested on the mechanics. As long as you recognize this at a high level, you should be in good shape. Again, I say that because this is material that you will be tested on at level 2. And then with the asset-based method, we need to calculate the net asset value, which is the market value or the fair value of the total assets minus the fair value of the liabilities divided by the number of shares outstanding. Investment risks. Generally, real estate investments are considered relatively safe compared to stocks, but risks still exist. Property values are subject to variability based on national and global economic conditions. I would also add local conditions to this. There is a risk associated with your management team. This is the real estate management team selecting the right real estate properties. Obviously, there is a large choice, and the question is whether the management team is selecting the best properties to invest in. Then there are risks associated with the financing mechanism. Is your real estate management team using the best financing strategy? And then is the team properly managing the real estate property? There is a risk associated with the fact that the expenses might go up unexpectedly. Very often leverage is used when making real estate investments, and leverage magnifies risks.